Welcome back, you legends. I'm Dr. Cal, and I do apologize for not uploading yesterday's video. We had a power outage, so we simply could not get the video out. But bear with me. This is going to be a very good one. Please watch till the end. And I'm going to run through this very quickly, just in case the power cuts out again, God forbid. So please bear with me, and I'm going to sprinkle out throughout the video my trades that I've taken, every single one since really early March, since the beginning of March, since the first trade I took in March, every single one, the winners and the losers throughout the video. So please watch till the end because I'm going to share them at random points, and I'm going to make a follow-up video to discuss every single trade, how we entered, how we exited, and all of that good stuff. So let's get right into this video. Today, the stock market is basically flat. We gapped down in the pre-market session. Then we continued to rally till the end of the day. The Nasdaq closed flat. So was the S&P. The Dow closed slightly up 0.3%. If we take a look at the stock market map, we have big tech suffering today. Microsoft, Apple, and Google suffering today, the biggest losses. Then we had some pockets of green, including farm and equipment. We had semiconductors doing very well. Semiconductor equipment and materials doing okay. Then we had some defensives like Costco and Target doing okay. And autos, GM and Ford. So we had a bit of rotation into value as well as semis, which is a bit of a confusing mix today. We had industrials lead, basic materials, energy, cyclicals, and then we had communication services lagging, utilities, tech, defensives, and healthcare flat on the day. So we were led by industrials, materials, and energy, the inflationary parts of the S&P 500, the inflationary sectors in the S&P 500, and that's all off that hotter than expected econ drop that came out last Friday, right? That hotter than expected jobs report. Here it is, folks. Unemployment rate 3.5%, one of the lowest in probably, I don't know, 5 decades or so. Non-farm payrolls slightly lower than forecast, but then we had average hourly earnings coming down year on year from 4.5% to 4.2%. So that's good news, but we do have that surprisingly low unemployment rate. And then we had government payrolls come significantly higher than expected. Then we had average weekly hours basically unchanged, and participation and labor participation rate rose slightly from 62.5% to 62.6%. So that's a lot of jargon. All it means, guys, that the jobs market is still strong. Unemployment is still very low. Non-farm payrolls starting to crack a little bit to the downside, which is good news for inflation. Then we had average hourly earnings also coming in slightly below consensus and forecast. Also good for inflation. But overall, the market did not really like these numbers all that much because, again, look at this. We had a rotation out of tech and into inflationary sectors. So that's how the market is reading it as of this moment. But next up, guys, we do have CPI coming out this week, Wednesday, 8:30 a.m. We have core and headline inflation coming out before the market open Wednesday. So tomorrow's price action is going to be telling. Usually, guys, we like to see the market weaken ahead of CPI so we can get a nice rally off CPI. If we get a crazy rally tomorrow ahead of CPI, that would be bad luck, unfortunately. I do want to share this very interesting chart by Sentiment Trader, and it looks at smart money versus dumb money. And it's not, guys, it's not institutional investors versus retail. It does not look at that. What it looks at is that smart money is defined as money that does not buy and sell too frequently, right? It's smart money. It's money that only deploys liquidity when it makes sense, and it only takes profit when it makes sense. While dumb money is that fast money that's in and out very quickly. And usually, guys, dumb money follows price action. So when you see the market rally, you see dumb money flow into the market and smart money begin to take profit. Usually, guys, after the first cross, when the money crosses above smart money, we get a market top about a week or two later. For example, we had a cross here. The market topped, I think, about a week later in August. Same thing here, guys. Early this year, late last year, we had that same thing. Dumb money crossed smart money. The market topped about a couple of weeks later. Here we had the first cross, right? Dumb money crossed smart money for the first time. And what we will be looking for next is a local top, then the dumb money crossing down below the smart money. And that's usually only happens after the stock market has already topped, including in August, including right here in late last year in November, right? We had the dumb money cross below the smart money, and that did mark the stock market top. So that's kind of what we're looking at now. We're looking at one final push to the upside, a top coming in here soon, probably within, let's say, the next 5 to 10 trading sessions. If we take a look at the daily chart for the S&P 500, here it is. We are unchanged since really March. Look at this, the price action, up, down, up, and then nowhere. We are back to March 31st. Nothing has changed, really a lot of chop. And it's the market waiting for that pivotal CPI data coming out in a couple of days. Let's take another look here, guys. This is a statistic by Dean Christians, and it looks at S&P 500 breadth. Here's what he had to say. According to Bianco Research, 8 stocks are keeping the year-to-date gains in the S&P 500. This was posted April 1st, and look at this, guys. Price action pretty much unchanged since the beginning of the month. What else does he have to say? Well, it's only 8 stocks out of 500 in the S&P 500 leading those gains, and it's those big cap tech stocks that we looked at earlier, right? Those that are beginning to weaken: Microsoft, Apple, Google, etc. And please take a look at this video. This is an amazing video by Eagle Eye that shows what happened after the banking crisis about a month ago that resulted in that stock market bottom. Here it is, March 13th. What happened and what really led the market out of that significant period of fear and uncertainty. Take a look. So as you can tell, guys, during that period of extreme fear and uncertainty, what happened? Money came running out of financials and into really big cap tech and the big banks. So the financials crashed, money came flooding out into big cap tech, Apple, Microsoft, Meta, Amazon. All of these companies really allowed the market to stay afloat as those financials collapsed. As you can clearly see, the turmoil in the markets was a tailwind for the big banks, which is exactly the opposite of what you want to happen. But unfortunately, this has been a trend for years and years and years, and it hasn't changed. It has only gotten worse. Money coming out of smaller banks into big banks, consolidating these too big to fail banks. It's potentially a new disaster waiting to happen a few years down the line. So let's jump back into the daily chart for the S&P 500. PPL continues to be positive. Histogram continues to be positive, slowing down slightly, but continues to be positive, holding above the 9-day moving average, which is a bullish sign. Overall, the market is still in a bullish context. That following that March 13th bottom, the market has been trading perfectly within this ascending channel. We haven't yet tagged the bottom of the channel. We do have a bunch of gaps here that I want to talk about on the hourly chart. By the way, guys, this is a proprietary chart with proprietary settings for the stochastic and the PPO. If you want to have live access to this exact chart, check out the link in the description to join our trading community. I began sharing this chart about a couple of months ago, and it's been working beautifully for us. Now, we do have a couple of gaps here, guys. The first gap is at 403.5. The second gap is at 401.5. As a trader watching this, waiting for a proper dip to go into the market to go long, I haven't seen that quite yet. This is a very shallow pullback. Look at this, guys, from the top to the bottom of this pullback, 1.5%. If I take a look at every single pullback here since the beginning of this bull run, look at this. Boom, top to bottom, 2.5% pullback. Another one, here it is, 2% pullback. Another one, here it is. Take a look at this, 3% pullback. And we had a pretty, really nice run here, 4.5% since that low. No real pullback since. If you are a bull looking to go long, the market hasn't really provided a proper risk to reward entry since that March 28th low. If I took a look at prior rallies here, guys, we do have a lot of these very nice pullbacks that do allow bulls to enter and bears to exit. Look at this, 2%, 3%, another one, 2%. So this very meager 1.5% rally is not very appetizing. And the stock market, guys, just like any market, if it does not give me a good deal, I do not buy. And it simply does not give me a good deal here. It did not give me a good deal. We are hovering above the medium-term moving average and above the fast moving average, but we are still quite a distance away from the slow moving average, and we do have a lot of unresolved business below that needs to be resolved, I think, before a lot of bulls can commit to the long side. Stochastic is beginning to curl down, yet the PPO is beginning to curl up. So a lot of conflicting data here, and that's because the market hasn't done anything for a week now, simply waiting for that CPI report on Wednesday. Now, I want to talk about the triple Qs, the Nasdaq. What's been happening with the Nasdaq? Well, we had this breakout from the January low. We had a pullback to this support line. We haven't tested that support line since really the low in March. The market has been rallying. It came back, retested or back tested the highs from February, and those highs have held. So this does look bullish to my eyes. The market is wedging, but I don't think it really tops until we go all the way back up to the August highs at $333 on the triple Q, the triple Qs. And that's because, guys, this is the full measured move from this double bottom right here. Boom, double bottom, positive divergence. If we take the distance from the bottom to the neckline and we double that, we get a perfect full measured move that coincides perfectly, I mean to the penny, to this gap right here. So usually, guys, these are not coincidences. It's a lot of algorithmic trading that drives this sort of structure, and it really does not realize its full measured move until $332. And so I do expect some upside left in the Nasdaq, but I do want to see a deeper pullback, especially in the S&P. The S&P has held quite a bit better than the Nasdaq here, simply because of the Dow Jones. The Dow Jones has been very strong, but the Dow Jones is again approaching this critical level of resistance. Look at this. It stopped every single rally really since November of last year. We are about 0.7% away from that significant resistance line. So if the Dow begins to slow down, finds resistance, stops here soon in the next, let's say, 5 to 10 trading days, the triple Qs, the Nasdaq needs to pull through to bring the S&P and the overall indices up. That's likely what is going to be needed to bring the S&P up above these highs back in January, if at all. So a lot of things at play here, guys. Since that bottom in March, we had that shift in the market, money flowing out of small caps and medium caps into large caps and into big cap tech as well as big banks. And that resulted in that really bizarre statistic where only 8 stocks led the entire stock market up since that March low. And we are likely to see money flow out of those big cap tech stocks, Apple, Microsoft, etc., and back into the smaller caps and back into the overall ecosystem to bring the market up, because I think a lot of these are running into resistance. Case in point, this is Apple, guys. Look at this perfect tag and rejection of our really long-term resistance line. Perfect tag and rejection, perfect tag and rejection every single time. This was no different. Now, I do want to point out something very significant that's been happening, and it's this. As soon as Apple does this, as soon as Apple breaks below its channel, 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 what happens? Well, let's add the S&P so you can guys see what I'm talking about. The S&P suffers a lot and it usually tops. Look at this. So this is Apple up above and this is the S&P down below. Every single time Apple has broken below its channel, the S&P has stopped, including here. So in this example, the S&P topped 3 days prior. In this example, the S&P topped 4 days prior. In this example, the S&P topped about 5 days prior. In this example, we do not know quite yet. We could get a nice pullback that breaks this ascending channel, fills all of these unfilled gaps, 1, 2, 3, a lot of these gaps. Then we could get one final move to the upside that could bring the Nasdaq to its top, this full measured move finally. And if you're a bull, that's kind of what you're hoping for. You're hoping for this unresolved business to the downside to get done with, so you can go long and catch that bigger move to the upside ahead of the Fed meeting in early May. And what's going to happen at the Fed meeting? Well, let's take a look at the dollar index. The dollar index is suggesting, guys, that the market is now pricing in one further rate hike coming out at the next Fed meeting. In my personal opinion, I completely agree with what the dollar is doing. And that's because I do believe that the Fed is going to raise rates in the next Fed meeting. And that's probably going to be the last rate hikes. And that will end the rate hiking cycle in this expansionary cycle in the economy. The DXY, the dollar has been rallying for 4 consecutive sessions. It's about to complete a bullish cross on the PPO. If we take a look at the 10-year yield, pretty similar look here, guys, a double bottom, and the PPO is very close to a bullish crossover. This suggests to me that the market is expecting the Fed to raise interest rates again in May, and that potentially could be the last time the Fed raises interest rates this year. Now, if that does prove to be the case, we'll see the market sell off on the CPI data. We could see the market, boom, complete a double top, sell off on CPI, finally fill these gaps, and then we could see the market finally push back up. Obviously, guys, this is speculation. What I'm looking for, I need to see these gaps get filled down below. I need to see all of this business get taken care of. And if I extend this a little resistance line back, if we get a back test, a beautiful back test, look at this, break, back test, gap fill right here, boom, gap fill, back test, that could send the market significantly higher from here going into that Fed meeting. And the market will like it if the Fed signals that May is going to be the last interest rate hike. The market will likely complete that 3 drives at a high that I talked about, boom, once, twice, 3 times, and that will likely bring the market to the top for the year at 430 on the S&P, and we could see the market significantly weaken in the back half of the year as the economy continues to deteriorate, and as that filters into company earnings, that will likely bring the stock market to its top, and we could see a continuation of this bear market and new lows from that point on. Now let's take a look at the VIX. The VIX has been trading in a range. The volatility index has done really nothing since the end of March. We've done nothing. The market has tried to push volatility up, but every single time volatility goes up, it gets sold down. The market participants, probably retail, steps in at VIX 20, buys the S&P, and that's really what's been holding the S&P at this range, really at 406, 405 and a half. And the VIX really failed to complete any meaningful breakout. It continues to trade within this range, and CPI will likely determine whether the VIX is going to break to the upside, bring us that significant pullback that we're looking for, and a gap fill all the way down to 396, or whether the VIX is going to get crushed and will move higher from here before we fill those gaps. This is an extremely uncertain market, so we do not want to predict anything here. We simply want to see how the market reacts at the key zones, and build our trading plans accordingly. Now I want to talk about the yield curve. This is the 10-year yield divided by the 2-year yield, and it's still in deeply inverted territory below that 0 line or 1 line. But if you notice, guys, every single time the yield curve goes into inversion and then it begins to steepen, that's when the market tops and we get that significant sell-off. That's when the market tops and we get significant sell-offs. That's when the market tops and we get significant sell-offs. The yield curve is beginning to steepen again, and that will very likely bring the market top and that significant sell-off likely in the back half of the year as the yield curve steepens significantly more so, as the Fed likely begins to cut rates, as the Fed is forced to cut rates due to the significant deterioration in the economy. By the way, guys, every single one of these is pretty much the Fed pivoting, right? This is a Fed pivot. When the yield curve exits inversion, it's pretty much the Fed pivoting, ending its rate hiking cycle, ending its rate hiking cycle, ending its rate hiking cycle. Usually we get a nice little pop and then a big sell-off, a nice little pop, big sell-off, nice little pop, multi-month pop, probably anywhere between 1 to 3 months, and then we get a major sell-off. That's what I'm looking at right now, guys. I'm looking at the market potentially to begin rallying into the middle of the year, into the summer. If, and there's a big if here, if earnings for Q1 come out better than expected or not as bad as feared. If that happens, if earnings are not as bad as feared, the market should, like the Fed, pausing, and it should rally. But as soon as it realizes that the Fed is not going to cut rates as soon as it wants, because really the market is pricing in rate cuts immediately after the last rate hike in May, the market is pricing in rate cuts immediately after that, starting in the summer. If the Fed holds rates constant, the market will be extremely anxious and will likely throw a tantrum and really see significant declines after completing that triple top with a triple negative divergence. Now, if we take a look at the GSG, the commodity ETF, something very interesting has been happening since mid-March. Commodities have been rallying. This is very bad news for inflation, right? So the reading for March will probably come in as expected or even lower, but the reading for April, that's going to be the big question mark, whether commodities are going to continue to trade in a range or even break out from this point on. That's going to be a major problem for inflation. And if we take a look at the monthly chart does look like a bull flag. Look at this. This is a massive flagpole. This is a very clearly defined bull flag. And if we get a breakout, commodities are going to explode, absolutely explode. And that will crush the stock market, will crush the economy, will push inflation higher. The Fed will need to raise interest rates even higher, if you can imagine that. So overall, the commodities picture is a little bit concerning, especially if the Fed pivots. I think commodities will see an explosion in reaction to the dollar declining. Now, if we take a look at TLT, long-term treasuries, I track this chart up top to find divergences between the TLT and the S&P 500 down below. And if you notice, when the S&P is rallying and TLT forms a double top, usually the market tops, usually the market potentially is topping now ahead of inflation, ahead of the CPI print, potentially, we don't know yet. We simply do not know because CPI is a binary event that could send the market in either direction. That's why I really do not really try to front run CPI. I usually see what CPI does and then react. And those have been the best trades for me so far. But TLT is weakening. We are seeing a double top, even on the PPO, a double top on the daily chart. So it is weakening here as the dollar has been rallying and as yields have been trying to find a local bottom here, potentially to backtest this 50-day moving average at 3.7%. Now I want to talk about big cap tech because a lot of these big cap tech companies, guys, have rallied significantly and are now running into major resistance levels. Exhibit A is Google. Google, I think, will probably top here very soon. It is putting in a double top with a negative divergence here, and it's running into the upper edge of its ascending channel. If we take a look at Microsoft, pretty close to a top here. The full measured move should really push Microsoft all the way to $295, and that will likely be the top for Microsoft, especially as the histogram for the PPO has been significantly declining. If you take a look at Apple, Apple's pretty close to a top if it hasn't topped yet on April 4th, right? It tagged that resistance line perfectly. It could, again, form a double top, just like here in February ahead of CPI or on CPI, and then top and come back down. And again, if we take a look at our pal AMD, the chart that could tell the future. If you remember, guys, from my last video, I talked about AMD and how it could tell the future. And we basically saw the sell-off in the S&P 500 because of the weakening in AMD. Every single time we had a completion of a bearish crossover on the PPO for AMD on the daily chart, we had the market really top within about 5 days or so. Here's Exhibit A. Look at this. PPO crossed down, market topped about a week later. In this example, the market had already topped. In this example, the market is likely now hammering out a local top. This example, the market had already topped. In this example, the market had already topped. And if we take a look at AMD, a closer look, again, it is trading within this ascending channel. Let's fix up this channel a little bit. There we go. We are still quite a ways away from the 50-day moving average, from this prior high, this swing high. So I do expect that this is likely a dead cat bounce that will fail, especially as the PPO is negative. So these are counter trend rallies that will likely fail. And we do have a couple of these examples, including this rally here and this rally right here and this one as well. Look at this. Boom, breakdown, rally to the 20-day moving average, continue to sell off. Breakdown, rally to the 20, continue to sell off. Breakdown, rally to the 20-day, continue to sell off. Breakdown, rally to the 20-day, and we are likely going to see continuation of the selling. Let's take a look at the Dow theory model. Up top is the Dow Industrials, down below is the Dow Transports, and at the bottom here is the S&P 500. And track this chart to identify divergences, including this major divergence that is now building between the industrials up top and the transports. The transports usually, guys, are leading indicators. They run ahead of the market and they top ahead of the market. Transports have topped all the way back in February. We have failed to take out that high since then, and we have continued to make lower highs, including recently here as the industrials have made an equal high. The transports have made lower highs. Even if the Dow Jones industrials continue to rally and we make a higher high, the transports will likely make an equal high and continue to diverge. So again, another data point that suggests that we should be patient here to try and catch a proper entry to go long the market. If we take a look at risk appetite, this is one of my proprietary indicators that looks at risk appetite in the bond market. When we get a switch from green to red, usually appetite switches from risk off to risk on, and we see the market rally, we see the market rally, we see the market rally. We are still in a risk on mode here. But again, that could change very quickly if the market tries to hammer out a top here soon, as all of those other indicators. Now let's take a look at our trend indicators. This is the BPSPX, and I track this indicator to find divergences between the S&P and the BPSPX. Example, here we had a significant negative divergence, significantly lower high here, equal high, the market topped and we had a sell-off. Another example here, significantly higher high and significantly lower high on the BSPX, and the market sold off. I think the major tell is when the BPSPX crosses below 60. Usually that happens after the market has stopped. Usually that happens after the market has stopped. Usually that happens after the market has stopped. This is the only exception here, guys. The market topped about a few days later, but on a closing basis, the market did top right here. Another really small exception is this one, but I really wouldn't count this one because we need to see the BPSPX cross the 80 threshold. So here it is, the 80 threshold. If we get a weakening from 80 all the way down to 60, that usually marks a stock market top. This is really the only exception, and I remember exactly what happened on January the 19th. The market was in fact topping and going to crash, but we had the Fed step in through its mouthpiece in the Wall Street Journal. And that article in the Wall Street Journal did give a second life to the S&P, and we had a quick bounce up and the market continued to rally higher from that point on. Another critical trend indicator is the summation index. This is the gold standard to identify whether the market is in an uptrend or a downtrend. Pretty simple. Cross up, uptrend, cross down, downtrend, cross up, uptrend, cross down, downtrend, cross up, uptrend, cross down, you'll get it, downtrend. Pretty simple. Really, any sell-offs in the S&P in the context of a summation index that's rising is a pullback. Any sell-off in the context of a summation index that's rising is a pullback. And so we are still in a uptrend according to the summation index. That hasn't changed and will likely not change unless something major breaks and unless the earnings season is horrifically bad. So again, pretty likely here, guys, local top, a decent pullback here fills the gaps, and we go long and the market continues to rally from that point on. Now let's quickly look at breadth. Breadth has been improving here, guys. PPO crossed up and triggered a buy signal, buy signal, buy signal. And usually, guys, these signals last quite a while. This was the only exception back in May. Otherwise, usually these buy signals lead to prolonged trends. So again, I'm looking for a pullback and continued rally from here to complete that 3 drives at high, triple top with a triple negative divergence and weakness coming in the back half of the year. Now let's take a look at the money time machine put to call ratio buy and sell signal. This is my own variation of the buy and sell signal of the based on the put to call ratio. We are still in an active buy signal. We will not get a sell signal unless the put to call ratio goes all the way back down below 0.8, crosses back up, and the PPO crosses over. We are still quite a ways off from that happening. Let's take a look at the meme index. And here, guys, this vertical gold line marks when the fear and greed index crossed above the 50 level. Usually that's when meme stocks like to rally, and we are now consolidating. We've been consolidating for quite a while. We had a break here, a back test, another rally, another back test, and we are likely now getting ready for a major rally in the meme stocks, if you can believe that. Look at the 50-day moving average. It is now crossed over above the 200-day moving average. So we got a golden cross in the meme stocks of all things. And so if you see GME, AMC, all these stocks go crazy in the next little while, that's to be expected because the fear and greed index predicts that likely is going to be the case. Here it is. This is the fear and greed index. We are now at a reading of 60. We had a break above 50 in late March, and we stayed above 50 since then. The market usually doesn't really find the top until we hit 75 or above, including back here in November and in the February tops. Market momentum is now improving. The 125-day moving average is beginning to curl up. We have held it twice now, and it will likely continue to hold. Stock price strength continues to strengthen. Breadth is improving, and the put to call ratio is continuing to decline and will likely decline even more. Market volatility is trying to find a base here, but again, if CPI comes below expectation, I think the VIX will get crushed this week. Safe haven demand is declining. Stocks are significantly outperforming bonds. This is signaling extreme greed. And then we have junk bond demand is still holding steady. In terms of economic events, tomorrow we'll have the business optimism index. Not a lot of really market moving events tomorrow on Tuesday, but Wednesday we'll have the CPI core and headline before the market open. So to summarize, guys, I do expect the market to try and form a local bottom here, likely rally on CPI, form a local bottom, come back down, really finish this unfinished business down below, and fill all of these unfilled gaps, and that will likely provide a nice buying opportunity as we enter the earnings season. If you'd like to follow my daily live analysis, please check out the link in the description below. I do share my live analysis every single day in the trading community, as well as all of my trades and investments in real time. Stay tuned for the trade recap video coming up next. And that's it, folks. That's all I have for you today. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.